For most of the 20th century, life insurance lived in a neat, rigid box. On one side was term insurance, simple, temporary, inexpensive, but unforgiving. You outlived it, you got nothing. On the other side was whole life insurance, permanent, predictable, safe, and inflexible. Premiums were fixed, cash value grew at a pace decided by the insurer, not the policyholder. It was built for stability, not choice. And for decades, that was good enough until the world changed. The storm of the 1970s. The 70s were not kind to certainty. Inflation surged, interest rates exploded into double digits. Savings accounts and money market funds began offering returns that made traditional whole life policies look slow and outdated. Policyholders started asking uncomfortable questions. Why is my money locked into low returns? Why can't my life insurance adjust to my life? Why does the insurance company control everything? Behind closed doors, insurance companies were facing the crisis of relevance. Their old products were built for low interest, predictable world that no longer exists. Something had to change. Instead of discarding life insurance altogether, a new idea emerged, one that would quietly reshape the industry. What if the cost of insurance was separated from cash value growth? What if premiums weren't rigid but flexible? What if cash value could earn market-based interest, not just declared dividends? What if policyholders could see, adjust, and control what was happening inside their policy? This wasn't just a tweak, it was a philosophical shift. Life insurance would stop being a black box and start behaving like a financial instrument. In the late 1970s and early 1980s, universal life insurance was introduced, and for the first time, policyholders were treated less like passengers and more like pilots. Universal life allowed flexible premiums, paid more, paid less, or even skip payments if cash value allowed. Transparent costs, mortality charges, and expenses clearly itemized. Interest sensitive growth, cash value tied to prevailing interest rate, adjustable death benefits, coverage that could evolve with life stages. It reflected a new reality. People's finances were no longer linear, and their insurance shouldn't be either. Universal life wasn't created to be flashy. It was created to restore balance. Insurers could remain solvent in volatile rate environment. Policyholders gain control, flexibility, and visibility. Life insurance could now adapt to inflation, income changes, and long-term planning. Became a bridge between pure protection and long-term financial strategy. Not perfect, not foolproof, but radically different. Universal life opened the door to everything that followed. Index universal life insurance, variable universal life. Modern policy design focused on accumulation, income, and leverage. But at its core, universal life represents a single turning point in financial history. The moment life insurance stopped telling people, trust us, and start saying, here's how it actually works. Universal life wasn't born from greed or innovative theater. It was born from pressure, economic pressure, consumer pressure, and the realization that financial tools must evolve with the world they serve. And every modern conversation about flexibility, control, and strategic insurance planning trace back to that moment when the industry finally admitted one size no longer fits all.